Hi, I'm Jim Jackson. This is my colleague, Kevin Kaase, and we are bonding over bonds. Kevin, very much a mixed week in fixed income last week. We saw Treasury bonds across the curve go up slightly in yield. Corporate spreads were flat. So it ended up being that Treasury bonds and corporate bonds were down a little bit, high yield and munis up a little bit. So nothing really happened that much in the markets. Two news items that I think are noteworthy is that the Fed announced that it's going to wind down its purchase of corporate bonds and ETFs. We don't think that's really going to have a big impact on credit spreads. And May's jobs report was much stronger than April's disappointing report. We would caution, though, taking much stock in any one single jobs report and just look at the long-term trends. And the long-term trends, obviously, there are positive as jobs keep coming back after the COVID onset last March and April. So today, though, we'd like to peel back a layer on something we talk about each week, and that is the amount of bonds that are being issued into the market.
That's right. Thank you, Jim. It's definitely been a crazy couple of years of bond issuance. And this year, we're on track to have the second busiest year on record, second only to 2020. In 2020, there were two primary drivers of companies coming to market. One is the traditional refinancing, where a company has a bond mature and they have to issue debt to repay that maturity. Secondly is liquidity issuance, otherwise known as survival issuance, due to the unknown impact of COVID. Companies were really trying to build up their cash reserves in this uncertain environment just to prepare, if you will. This all started back in March and April of 2020.
Sure. And Kevin, I think issuance has remained strong, but the drivers are different this year.
That is true. I mean, we're definitely seeing a strong year of issuance, if you will, and here in 2021. As I mentioned, we've seen 5 consecutive months of over $100 billion of issuance. But you're right, the drivers have changed. It's not only that, the companies were just looking to survive last year. This year, they're actually looking to, they're issuing for mergers and acquisitions. They're issuing for share buybacks and CapEx spending.
Kevin, I think this begs the question is, what does this mean for bondholders, right? And we think we would advise, and this is in all sort of market environments, that you maintain a fixed income portfolio consistent with your risk tolerance. Second, we would advise when there are occasions in the market where credit risk is potentially increasing, that your asset manager maintains a robust credit research team so that they can mitigate these risks. And third, we would advise you maintain diverse credit exposures in fixed income to mitigate the risk of something going wrong with any one particular bond. So Kevin, thank you. And thank you, the viewer, for bonding with us over bonds.